Hey friends, welcome back to another session on investing. My name is Leander Atayed and I am an AMFI registered mutual funds distributor and also certified by the NSC in technical analytics. Without any further ado, let's just dive in. A little disclaimer for you guys. Alright, so what's a stock or a share? In very simple language, if you own a share or a stock, it means you are a partial owner of a company. As the company grows, of course, you will grow because the price of the share will rise. If a company goes into losses, then effectively the share price also can decrease. Of course, here you got a few examples of companies who are listed in the stock markets like Hindustan Unilever. You probably are having products like their soaps, detergents, etc. in your house. Bata, a shoe company, you must be wearing their shoes. Nestle is into food products basically. So these are just examples for you. Now, what is a mutual fund? A mutual fund is a combination or a pool of funds wherein multiple investors invest their money, and that money is invested in different products or different instruments based on what the objective of the fund is. So the investments are held in a trust which the investors are the direct beneficiaries of. There's something called trustees which oversee the management by an appointed investment manager. A simple representation: you as an investor, if you buy a particular mutual fund, you are effectively owning multiple companies or a little bit of multiple companies. So what are the benefits of a mutual fund? First of all, diversification. As they say, don't put all your eggs in one basket. So basically you are trying to buy different companies or different products such that it takes care of the market volatility. That is the ups and downs. You are effectively reducing your risk by diversifying, of course, and very important, you don't have to break your head because the fund manager, who is a very experienced person in the financial field, they are managing your money and choosing where and where not to put the money basically. So what's an AMC or asset management company? In simple words, there's something called an investment manager. They are appointed by the trustees. Of course, the Security and Exchange Board of India has to approve that, SEBI. The trustees and the AMC enter into an investment agreement. They are required to invest about 1% in open-ended schemes. Open-ended schemes, in simple words, are those schemes which don't have an expiry date as such. It goes on till the investors decide to redeem their money. They should have at least a net worth of 50 crores. 50% of the board of the asset management company has to be independent. Independent in the sense, you cannot have your employees or your relatives as part of the board. They have to be some other people. AMCs or one mutual fund cannot be the trustee of another mutual fund. And of course, the AMCs cannot engage in other businesses other than financial advisory and investment management. So how does a mutual fund work? Of course, you as an investor, along with other investors, would invest your money with a fund manager. The fund manager decides where exactly the money is to be invested, in which stocks or which securities. Whatever profits are generated or returns are generated are directly shared by the investors. So hence the term mutual funds, because everyone is mutually benefiting from it. A little bit of classification of mutual funds. First of all, there are passive and active funds. Passive funds are those funds which replicate or invest directly in stocks which are like the index, like Nifty 50, or you have Sensex or BSE 100. You are just replicating the indices. An active fund, of course, is a fund wherein the fund manager can choose some different stocks or different sectors. The aim of this active fund is to achieve better returns than the indices like Nifty or Sensex or Bank Nifty, etc. Of course, the cost wise in a passive fund is rather less because it's like a no-brainer. You're just copying the main top stocks of the market. Active fund, it requires a lot of more efforts. So that's why obviously the expenses or the cost for investing in an active fund will be rather or slightly higher. So how can you invest in a mutual fund? Of course, first of all, you can go with direct physical application. You can go to the mutual fund house and buy the stocks or buy the funds from there. You can invest via online mode. You can invest using their apps. Every AMC has an app in today's world. Or you can make your life easier by contacting a mutual fund distributor who has been in the field for a few years at least and having valuable experience, and they will most definitely be happy to help you out with this entire process. So how can you invest now? There are two major ways. One is something called a lump sum investment, wherein you put in a larger sum of money at one time and you hope for it to grow in the years to come. Of course, in short term, there will be ups and downs. That is, your money might decrease in value temporarily, but the aim or the idea is to hold the money for a few years so that as the markets grow, you or your investment also grows. An SIP or a systematic investment plan is a more strategic approach wherein you buy the mutual fund or units of the mutual fund at regular intervals, whether it's quarterly, weekly, monthly, half yearly, or annually, and you keep on investing regularly. Basically, you can always choose the date of your investment depending on when you get your income or your salary every month, so it's pretty flexible for you. Looking at investing perspective options, first of all, you have a growth option wherein you invest in the fund, the profits are kept there, and over the years as the funds grow, your net value of course increases. Dividend payout option is an option wherein if a company issues dividends or gives back something to the investors, that or those dividends will be given to you or credit to your bank account. Of course, the value of the unit, the NAV, will decrease based on how much money is paid to you. Dividend reinvestment option is the plan wherein whatever dividend is paid, rather than you taking it to your bank account which is taxable, that same money is reinvested into the same fund. So effectively you'll either get more numbers or more units of the same fund, or the value of the fund will increase basically, or value per unit. Riskometer. Riskometer in simple words is a meter which tells you what is the risk factor involved, of course. Whether the fund which you're investing is a low risk fund, moderate risk fund, high risk fund, depending on it. Of course, the stock markets would be considered as a high risk fund because they move up and down pretty rapidly. A debt fund and a hybrid fund is something where we'll be talking about in the later sessions. Of course, they are rather less risky or more stable as compared to a pure equity fund. Of course, if you have any queries, you need any assistance, please feel free to contact me. I'll be more than happy to help you out in this. Alright, that will be all from us for now. I thank you and I request your support by your likes. Of course, please share this video with your friends and family and do subscribe to my channel. Thanks again. God bless and stay safe.